Now, Agusto Co forecast continued expansion of the Nigerian asset management industry with a 60 to 65% rise in assets under management, potentially pushing the industry beyond the 16 trillion naira mark within a year. Now, the Pan-African ratings firm notes heightened product awareness, increased institutional participation, and sustained retail investment momentum, particularly via fintech collaborations, will be the primary engine of growth. Omowonuola Kunle-Bello, head Fund and Investment Manager Ratings at Agusto Co, joins me now to unpack the report. Wonuola, thank you so much for joining us on the show today. When we're looking at Nigeria's non-pension assets industry, the sort of boom we've had so far, is this the golden age or a gilded cage? Where are we right now, contextualizing this boom using 2024 as our case study here?
All right, so thank you very much, David, and thank you for having me. So yes, you are right that the industry thrived, did exceedingly well. It grew in terms of assets under management by 82%,
yes,
to about 10.1 trillion. A lot of that growth was driven really by macroeconomic factors. So, I mean, I know it sounds a bit contrarian when you think, oh, when inflation is high, macroeconomic indicators are down.
And then a wave of reforms.
Yeah, so, and then it starts to beg the question then, how did they arrive at this sort of growth? But yes, while some macro indicators are negative, some were positive. So in terms of yields, returns, particularly when it comes to money market instruments, we saw a significant increase from about 7% on average last year to about 20% for 1 year treasury bills. I mean, so that in itself was a principal driver of growth. So you found a lot of people coming in and you know, investing. And then beyond that, I think you touched on that a little bit in your introduction. There's a lot of collaboration. So rather than competition, we were seeing increasingly is collaboration, particularly with digital investment platforms. So you find examples like maybe Cowrywise, for instance, where it's a digital platform licensed by SEC, and then you find United Capital, Stanbic, you know, all the, you know, established names having their platforms, you know, their products registered on those platforms. So it does two things. It gives Cowrywise on one hand, some credibility, seeing those names on there. And beyond that, on the other hand, it also gives the established names access to digital natives, to the young Gen Z, the younger millennials that might ordinarily not have patronized them through their traditional distribution channels. So when you think about that, so on one hand, so that sort of collaboration was also very instrumental to driving growth. And of course, there's a lot more education, there's a lot more awareness generally for investment products. And so those were the things in our view. So when you think about the macro factors, the fact that yields were doing really well, then you find the digital transformations and of course the better awareness for investment products in general. Those things in our view you know, were responsible for the growth. And
looking at the growth, we've also seen a firmer regulatory hand at this moment now. And then I also like one of the catchphrases you have here, the lie of the land, a game of giants. Really, at this point now, we still see the industry map is expanding, but power still remains concentrated. We're looking at the segregated portfolios. Walk us through some of the nuanced data we have at this moment here. And when we are still going back to this collective investment schemes at this moment now, the spread here, looking at the variety, new launches, about 29 new funds into the fray at this moment. Walk us through some of these details.
Oh, okay. So starting with segregated portfolios and collective investment schemes, I think people are more familiar with collective investment schemes because they're public. And that's pretty much the information that you find on the SEC website. But beyond that, you also have private collective investment schemes or HNIs or large-scale investors that patronize asset management companies. And then they come and say, okay, do you know what? Because of this scale, I'm going to manage this portfolio separately. So that's what it really means, segregated portfolios. Portfolios that are managed, you know, a bit separately from the pool, while collective investment schemes are managed as a pool. So, you know, over the years, we've sort of seen some sort of balance in terms of collective investment schemes and segregated portfolios. But more recently, what we're finding is that the segregated portfolios, at least in the last 2-3 years, have sort of, you know, increased at a much faster pace than collective investment schemes. So after the 10.1 trillion, I think collective investment schemes accounted for about 3.74 trillion, and the rest were segregated portfolios. Although the pace of growth for collective investment schemes in this year, you know, was about 82%, which is a lot higher than the 69% with the segregated portfolios, because there's a lot more retail, you know, push towards collective investment
It's just speaking to how the market is looking for that demand for diversification and liquidity and ethical options. And talking about how the game of play is going on at this moment now, Stanbic IBTC still takes the lead. Walk us through why they are and where we're seeing new competition coming, especially when we're looking at the likes of Cardinal Stone, Nuremberg.
Okay, absolutely. I mean, the top 5 asset management companies, non-pension asset management companies, control about 55.5% of the market. That's significant. So if you look at Stanbic on a standalone, by our estimate, I think they control about 25.7% of the market. The closest to them, I think, is United Capital, but about 10.9. I mean, and, you know, it goes down, you know, that way. Then you find the likes of Cardinal Stone, who's got licensed maybe 2-3 years back, and then Nuremberg, maybe a similar story, and they're beginning to chip at the old block. You're seeing them come into the market because they're also members of established financial services group. They might not be bank subsidiaries or banking affiliates, but they also have financial services group that they're able to leverage in terms of product distribution, particularly with the institutions and HNIs. You know, that sort of helps them as well to penetrate the market. At last check, I think Cardinal Stone had about 500 billion in AuM. That's about half a trillion. That's significant for someone that has, you know, less than a 5-year track record. So we're seeing that. Whether or not they'll be able to break into the top 10 or top 5, I mean,
that remains a question.
It remains to be seen. But I think with the Stanbics and the larger asset management firms, you know, they have the first mover advantage, you know, because they've been around for a long time.
Longer period.
They're also members of established financial services groups. So Stanbic is affiliated with the bank, with the pensions, you know, so they are known, people know them. There's some level of trust that is attached to being known. If you think about United Capital, there's even though they're separate, distinct from UBA, there's still that impression that they're part of UBA, and that confers, you know, some sort of positive sentiments.
Omowonuola, it's just about a minute to wrap up the conversation. We have to look at the digital frontier, and then when we're also looking at this looming talent war at this moment, the wave of emigration at this moment is really hitting businesses hard. But let's talk about the outlook for the market now, this $16 trillion mark. Can we reach it? Can we surpass it? Where are the risks ahead? Okay,
so I mean, it's clear where the opportunities are. I mean, it's a yields play. So long as yields are attractive, then, you know, we expect to see growth. I mean, of course, in terms of the risks as well, it's still macro risks. Because again, if yields
the very
fall,
same thing.
The very same thing that's driving it could be the deterrent so I mean, so yields very important, and like you mentioned, there are other things, smaller issues. How well the industry is able to leverage technology to deliver products to, you know, underserved markets, to bring on board new clients, things like that. Then you also have the concern generally with you know, wonder banks, so to speak, like the MMMs and you know, those sort of stories impair the sort of trust that people have and can slow participation. So those are sort of the areas where risks...
But I think just the bigger picture, beyond what asset managers can do, it's no longer about can you grow my assets, how long can you build value for me, especially when we're looking at the volatile terrain we have this moment here. Omowonuola, it's been a pleasure speaking with you. We'll leave the conversation here. That was the head fund and investment manager, ratings at Agusto Co.